Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course, Module 1, Trade What's Right in Front of You. Now, many people think that order flow is something that's relatively new in the last 15, 20 years, based on the advancements in computer analysis, but actually tape reading is a form of order flow and it's been around for over 100 years. One of the most popular books on trading is Reminiscence of a Stock Operator, and the main character, Jesse Livermore, was a tape reader. So, he was someone that used order flows back in the 1920s. And today, most of the interest in order flow comes from traders because they want to understand the market, right? Most losing traders don't want to take the time to understand the market. They just want to make money. But you can't consistently make money unless you understand the market. We all like to have indicators that tell us where to buy and where to sell. I have order flow based indicators, which I use as a tool to alert me of things in the order flow. But a lot of times, people just, I don't really care what's happening. Just tell me where to buy, tell me where to sell. And I think that's wrong, right? I think that's one of the reasons why you got this course is because you want to understand what is happening in the market. And, order flow, I think, is best utilized via an order flow footprint chart, right? I mean, people will argue, well, there's a dome. The dome is really order flow because it's orders coming in and out of the market. But actually, what's more important is what people trade in the market, what people's commitment is to the market. And when you look at a volume footprint chart, there's a lot of numbers. And honestly, people get scared of the numbers. But when you understand what you're looking at, then you really understand what's going on in the market. And you can understand where there's great buying opportunities and when there are great selling opportunities. And trading is like being a detective, right? Looking for that clue to solve the mystery, or in trading, the clue that can signal the beginning of a big move, right? This was in the S&Ps, and we had a big move. And if you look at what happened prior to the big move, if you're watching the order flow, it's pretty obvious, right? You could see how the delta is mostly turned negative. So you got very strong aggressive selling, you got imbalances in the bars, and you've got point of control acting as resistance. This is telling you, this market has more of a chance of going down than it does of going up. Now, the biggest hurdle for many traders is learning to see an opportunity early as opposed to waiting for it to become more developed. And, the reason why you want to get in as early as possible to a trading opportunity is, if you wait for confirmation, you get confirmation, the trading opportunity could have passed, or worse, the profit potential is decreased. So, you're going to get in late on a lot of moves. But if you read the order flow, you can understand what's happening as it's happening. You get into trades quicker instead of waiting for confirmation. I got to wait for confirmation. I got to wait for confirmation. And by the time you get confirmation, a third to a half of the move is over. And, this is a perfect example. Okay, so this is the S&Ps. We're rallying up. We got two bars with very strong aggressive buying in here, a lot of imbalances, right? Then we get up here, we peak, right? Market goes up, shoots up. We got buying imbalances up here on the top. We got some stopping volume up here on the top. Market reverses. We got point of control up near the top. And then the next bar, lower point of control, next bar, lower point of control, imbalances come in. But you could be getting short either the bar right after the high is made, or the next bar, or the next bar. If you're trading, well, we got to break out through the swing low. You're getting in 4 or 5 points at a worse price. But what you're seeing in this bar here, and I'll be talking about, these market internals with the max delta, the min delta a bit later on, so you could understand why this bar is such a great sell right here as it happened, as opposed to waiting 2, 3, 4, 5 bars later to take the sell, right? There's nothing wrong with taking the sell once we break 31.47, but I'm telling you, you should be able to get short up here at 31.50, 31.51. So you're getting in on the trade, 4 points earlier than everybody else. You're going to have more profit potential. You're going to have more wiggle room. And it's going to, your bottom line at the end of the month is going to be much better. So what you want to look for in the order flow is beyond just a series of price changes, right? You want to be able to see market change. You want to look at how market change is different than just price change. So for example, right, understanding market change, here's a market, it's just sort of grinding a little bit higher. But as you get up to this swing high up here, things have changed, right? You're sort of coming up here. You got, these nice, strong, positive deltas mixed in here. Points of controls, honestly, on this move up is just, it's going back and forth. But you hit this area. You got 4 point of controls right at the same level. Okay, so you're putting in sort of this value area here. You come back up. You match this point of control here from earlier. This is a bearish point of control. It's up near the top of the red bar. You start to come off. Next bar, there's a little red candle here. You trade right back up to that point of control. You put in a, what I call a small print, just 4 contracts trade. Market starts coming off. You see a buying imbalance in this red bar, which I'm going to talk about later in the trade setups. This is what I call layering in. People that have supply are, offering it out there. Right? They see this market is high, so they're willing to work offers. If the market's going up, it's easy for people that have a lot of supply to offer it out rather than hit the bid because the market's going up. But it often puts caps on the market. And then the next bar, you see a couple selling imbalances. The delta picks up again as negative, and the market sells off from the 58 area down into the 52 area. That's understanding the market change. It's not just because of one bar. You're taking into account these 4 bars, points of controls, the circle back up to the previous point of control here. You put it in the small print. You got the layering in coming in here. So understanding what's happening in the market, is going to give you a better trading opportunity. Here's another example. This time it's in wheat, right? Because, whether you're trading soybeans, wheat, corn, it's the same thing applies to whether you're trading E-minis, micros, whether you're trading Dow futures, whether you're trading crude oil or bonds. You're looking at the same things. And, what's happening? Market's putting in this nice little rally up here. Okay? Higher points of control. Then the market starts working its way back down. Okay, well, how can you tell that this market is getting weak? On this move up, you get up here, you're right up here, 1 bar off your high, you got a small delta, -9. Obviously, the next bar, -99, next bar, -91. You've got lower points of control, whereas on a move up, you're seeing higher points of control. Now you're seeing lower points of control, right? You're seeing market exhaustion here with this small print of 3, and the market is coming off. You're more inclined to see the market sell off at this point than the market to reverse and go higher, right? There's nothing after this red bar telling you this market has got any impetus to the upside. 0, right? And what happens is you get a nice move down from 533 all the way down below 530. This is crude oil. Okay, so the market, is kind of going sideways, and it dips in here, and then boom, reverses and shoots back up about 50 points. Okay, but if you can understand what's happening in the order flow, you'll understand why this market turned around and reversed. Right, I'm going to talk about the max delta and the min delta in, I think it's module 3. But what you have going on here is the market's kind of going down, but it's going down on less buying. You can see the internals 112. Min delta 51, then min delta -1, positive delta 60, right? 127. Buying imbalances coming in here, and the market shoots up, right? But what you're seeing in here, you're seeing market change. You're seeing the aggressive selling drying up, right? Getting lesser and lesser as we come down in here, and all of a sudden you see aggressive buying getting stronger as the market is going up, right? That's understanding the market change. Now, a lot of traders are focused on price, and price is decided by market participants who react to prices on the screen, right? To external information, which may or may not be readily available to all traders who can react to that information at different times. You got to understand, traders do not all operate on the same time frame. Traders do not all trade from the same information. Traders do not all trade from the same chart. Once we accept that the market's made up of traders with different time frames, information, and durations, we can respond accordingly to what transpires in the order flow in the near term and potentially the rest of the session. I see a lot of these Forex guys talking about how bank traders, they all look at the 4-hour chart. They don't. A lot of bank traders, all they're really concerned is with where they think value is, right? And where they think value is in the future. We don't all have the same information. For those of you that are kind of economic historians, look back and researched the Great Grain Robbery of, was it 1972, 1973? You know, that's when Russia was buying up all the U.S. wheat and, you know, and corn, and the price of soybeans, you know, also followed, and price of soybeans went up about 300% in 10 months. You know, the price of bread at that time doubled. But the information, you know, traders didn't have access to satellite pictures that we have now. This is actually around the time, you know, what was interesting about this whole, the Great Grain Robbery is it was right around the time that NASA started launching the satellites into space to track weather patterns, right? So, you know, most people in the U.S., especially the guy at the USDA at the time, because, you know, basically he subsidized the grain purchases from Russia to the tune of like $300 million, which is basically like free money, which they just turned around and I think bought more soybean futures and made a boatload of money to finance all their grain purchases. But, you know, they didn't, that information about the weather, you know, how severe the drought really was in Europe at the time wasn't widely known, you know, or if it was known by the guy at the USDA, you know, he sort of put it off. And what makes, you know, the whole Great Grain Robbery, you know, why they call it the Great Grain Robbery, one of the reasons is because, you know, while they were negotiating and making these deals, that information wasn't available to the public. You know, now when you know, Trump's advisors meet with, you know, China, you know about it, you know, as soon as the meeting ends. Sometimes during the meeting, you know, information gets leaked. But, you know, back in the 70s, the only people that knew that Russia was negotiating and buying all of these grains were just the people privy to that. You know, nowadays you'd consider that, you know, insider information. So, you know, in a way, but, you know, a lot of those commercial trading houses made a lot of money before, you know, the general public really understood what was going on and why the price of bread doubled in, you know, in such a short time. So, you know, we don't all have access to the same information. We don't all trade on the same time frame. We don't all use the same chart, you know. So, you know, you sort of got to get that out of your mind and, you know, and move on. Traders deal in the real world, not the theoretical world of mathematical formulas. You know, that's what everyone wants to think. Oh, I created this, you know, way to analyze the market. You know, it takes this equation, that equation. You know, now they call it algos. Before they call it modeling. But what's really important is the order flow, right? And especially, you know, order flow chart patterns don't repeat exactly the way fractals do, right? Everyone likes to say, oh, the market is fractal. But with order flow, you know, it does repeat itself. But what happens is, what's really happening is how traders react around price, right? And, you know, when it gets to a certain level, you know, emotions take over, right? And needs, that's how the market reacts. So I'm going to show you a couple of charts here. Same, but different, right? If you've ever been to Thailand, you know, they always sell these t-shirts, same. This is the E-minis. This is a 1 minute chart, okay? And you notice where the price is, 31.55, okay? Market is coming up here. Got some aggressive buying as we get up into this high. Then the market reverses, settles down. Next bar, a couple of imbalances, starts going lower, negative delta, negative delta, negative delta. Selling imbalances come in. Right, 31.55, market tries to pop up there. It runs into some supply, okay? Now what was interesting, a week before, on July 2nd, also right around the 31.55 area, this one's 31.56, market is going up. You get that aggressive buying, then market comes off, right? In this case, the next bar, this is a 5 minute chart. This first chart was a 1 minute chart. This is a 5 minute chart. Points of control all sort of lined up side by side. Aggressive selling coming in here. You got small delta in this red bar right after the high. Delta is 17, which is nothing. It might as well just be minus 17. Then the next bar, boom, big negative delta, 2,500, and the market sells off right down into below 31.40. You know, here, you know, it sells off from the 31.50 area down into, you know, the low 40s. There's a difference. This 1 minute chart is a 5 minute chart. But it's the same reaction, but the order flow is kind of similar, right? You got those imbalances up there, market rejects, comes off. Down here, or previous chart, market rallies up, you got the buying imbalances, market comes off. Okay, so same, but different. Now, a footprint chart does not repeat itself, right? But the behavior of the order flow does, right? This is important to understand when you consider all the different traders out there and their time frame for a trade, and even what type of chart they watch. You know, it's showing you it's a 1 minute chart, it's a 5 minute chart. Similar, but slightly different, right? Reading order flow in trading ranges is something that honestly is, when the market's in a trading range, it's kind of boring, all right? So, but what's happening is the market is facilitating trade, right? There's an equilibrium between supply and demand. However, when I say when we're trading in a trading range, it's kind of boring, it's from these trading ranges that big moves happen. The big moves are exciting, right? When you're in a trading range, it's boring. So, for example, here, right, we're sort of in equilibrium, going back and forth. Honestly, though, this market is feeling a little bit heavy. You know, got mostly negative deltas in here. Got these lower points of control. Got some selling imbalances. Does pop around, you know, does try to come right back up. Still can't get any higher than this area where you got mostly, you know, you got these 3 points of controls right around the same level. You can't even get up to this point of control. And then the market slams down. We were in equilibrium. Then the market breaks, right? And then it sells off, you know, 50 cents pretty quick. Another example, right? Equilibrium. What's one of the ways I could tell equilibrium in the market is when I see points of control lined up, you know, 3, 4, 5 levels all at the same level. Now there might be one case where one point of control is one tick higher. You know, I'd sort of average that in. But you know, we're in equilibrium here. Everyone's happy to sort of trade right around this price, right around this 31.73.5. Market starts breaking, breaks from, you know, 72.5 down below 70, below 69. So another case, equilibrium. You know, you're sitting here. This is crude oil. 1, 2, 3, 4, 5, 6 at the same level, and then another 2 right around, you know, one tick lower, right? And you see these small points of controls: 9, 1, 0. Then the aggressive buying steps right in. You know, this bar's got 4 buying imbalances, right? Half the bar is buying imbalances. Next bar, buying imbalances continue. And it's just, again, it's off to the races. You know, we make a move from, you know, even if you get in late here, 31.58 after these 2 bars, it's 58 all the way up into the 70s. So bracketed markets, you know, our market's trading in a range. So, you know, you're going to have 2 types of markets. You're going to have bracketed markets, range trading markets versus trending markets. You got to understand what type of market you're in and adjust to it. So again, what's one of the clues I look for? Are POCs that are just lined up nice and neatly, right? I'm always going to be looking for those areas, even though, you know, you're trading a little bit higher, a little bit lower. It's mostly trading in that range. This is a 15-minute period, and each bar, the most volume is at that same level. Then the market starts to break. I would rather be short than long, as long as we're trading below these points of controls. You know, POCs lined up. This is gold. This is at the high of the day, right? You're coming in right up at the high of the day, heavy volume. Not at the high, because, you know, there's some volume traded right above it. But you got 1, 2, 3, 4, 5 points of control right at the same level. One tick below, one tick above, right at the high. So I know there's supply up here. Do I want to be long or do I want to be short? You bet your bottom dollar I want to be short. If we're breaking away from here to the downside, you know, if we start trading below, you know, you could get short in here, 18.14, 18.14.20. All, you know, a quick $1 move right here over the next 5-6 minutes. So, you know, understand if a market is in equilibrium, because when we come out of equilibrium, that's where the big moves can come. So, you know, there's order flow traders tend to be short-term traders, right? We have a short-term outlook on the market, and you're trying to coexist with long-term traders, right? Long-term people have a longer term of the market, and really what you're trying to do is you're trying to understand when the long-term trader is in the market, because the long-term trader is the one that's going to create the trend, right? And what you're trying to do is jump on, follow what he's doing. And you know, that's where reading the order flow and understanding what's going on is going to help you, right? You're going to, you know, think of it like, you know, if you ever watch, you know, National Geographic or looked at the magazine, you see these pictures of the shark, right? The big, great white shark, and he's always got those little fish swimming around him. You know, the little fish know that the shark is going to, he's the top of the food chain, and if they want to eat, they better hang around him so they get his scraps. Now, I'm not saying, there's nothing wrong with scraps in trading, because, little scraps here and there add up to a lot of money. And, so if you understand that there's a long-term view of the market and the guy is getting, positioned in a direction, what you want to do is position yourself in that direction. What are you going to do? You're going to fight against him? Of course not. You have to be going in the same direction as the long-term traders. And that's, all about what trading right in front of you is about. So this concludes Module 1. In Module 2, we're going to discuss market internals. So I'll see you there. Bye-bye.